Good morning. You are watching live daily market outlook for Wednesday, 7th of March 2012, prepared by Windsor Brokers. The markets remain under pressure and concerned about a Greek problem as Asian shares were under pressure during the third consecutive day in a row, and the investors are growing more risk aversion with the renewed uncertainty over Greece's bailout and mounting worries about slowing global economies, overshadowing support from ample liquidity. The euro is losing ground after yesterday's fresh weakness, dipped to 131 so far. Looking for a possible test of 130 next support zone in the short term. A scenario of Greek bankruptcy on March 23rd remains on the table as the economic data could still deteriorate in Greece and shake all the economic assessments. For example, the manufacturing PMI for Greece further dropped. The Troika, the group that negotiates with the Greek officials, could find that Greece didn't actually pass the required decision. The bond swap also could go wrong, but not getting enough volunteers for the bond swap. Credit events or in the bond swap goes well, ISDA could finally trigger a credit event, causing everybody to rethink. IMF contribution. The IMF could decide on a very low contribution to the second bailout, putting more strain on the Eurozone countries. All in all, time is passing by, and Greece basically doesn't receive bailout funds. The debt-stuck country has bond redemption due on March the 20th. The money isn't available. If you add 7 days of grace, you get March 27th. The scenario of a bankruptcy announcement on March 23rd remains valid. So this is one of the scenarios for possible bankruptcy of the Greece. Also, according to the report obtained by Reuters, the Institute of International Finance considers a possible Greek disorderly default as extremely harmful for the Eurozone. In a document that from 18th February, the banking trade group warned that such an event would result in Italy and Spain seeking external aid in the face of the threat of contagion. They estimated that the damage of the Eurozone would amount to 1 trillion euros. Also, failure to complete the Greek debt swap with the private creditors, the deadline for which is March 8, so tomorrow, would mean considerable losses of the ECB and the need for further aid payments for Ireland and Portugal to protect countries from the fallout. The possibility that further financial sacrifices have to be made in order to preserve the common currency is starting to cause a stir in some of the core Eurozone countries. On Monday, the right-wing populist Dutch Freedom Party leader Geert Wilders announced that he will push for the Netherlands' withdrawal from the euro after receiving a report from a forecasting consultancy Lombard Street Research on how the membership damaged the country's economy throughout the years. According to Ambrose Evans Pritchard from the Telegraph, the Dutch government is unlikely to pay any attention to the findings, but the Freedom Party's populist campaign might force Prime Minister to take an even harder line in loan talks with Greece, Portugal and Ireland over the expansion of the EFSF rescue fund. The European markets opened in the red for the second running on Tuesday, actually for the third running today. The euro plunged to its new low at 131 zone amid growth concerns about concerns and news about Greece. So the quite bleak outlook for Greece from down under Australia economy. Release of the fourth quarter GDP disappoints as the result came at a disappointing 0.4% from third quarter 0.8%, and the forecast for today 0.7%. The Australia's resource-rich economy grew at a pedestrian 0.4% last quarter as business spending slipped from record high, knocking the local dollar lower and keeping alive the chance of further cuts of in interest rates. The quarterly rise in gross domestic product was half that expected by analysts, though much of the miss was caused by a sharp drop in farm inventories as grains stock were exported. Pardon. From the other markets, gold and oil remain under pressure as yellow metal dips below 1700 strong support, and the crude oil is also holding well below 106 level, currently holding at 105.20, keeping the downside under pressure as comments from the OPEC for the forecast for the 2012 are seen as significantly reducing the growth forecast and the demand forecast for 2012. Also, today's crude inventories are due to be released. Today's forecast is build of 800,000 barrels for the week ending 3rd of March, 2nd of March, pardon, compared to the previous week build of 4.2 million barrels. From today's calendars, we'll take a look now on already released. As we mentioned, the GDP in Australia came at disappointing 0.4%, while Japanese leading indicators also dropped compared to the forecast at 95.1. Today's reading is 94.9, however higher than the previous month release at 93.8. Switzerland, the unemployment rate as expected stayed unchanged at 3.1% with no significant impact on the Swiss franc against the dollar after release. The German factory orders are due at 11 o'clock GMT, and 0.6 is today's forecast compared to 1.7% of the previous month release. More important, actually, the key event of the day is U.S. ADP non-farm employment changed the key signal ahead of Friday's U.S. non-farm payroll data. That is expected to come in a positive figure today. 204,000 is today's consensus compared to last month release at 170,000. This is the good indicator for the non-farm payrolls that might come in better than previous release figure. Further today, building permits from this ADP non-farm payrolls, forgot to say, are at 13:15 GMT. At 13:30 GMT is US non-farm productivity quarterly release. 0.8% is today's forecast compared to 0.7 of the previous month, and revised unit labor cost quarterly release from US unchanged, forecast at 1.2%. Canadian building permits at the same time monthly release minus 3.1%, negative forecast for today compared to plus 11.1% of the previous month. As mentioned, the crude oil inventories are due today at 15:30 GMT, and in the late hours of US session at 8 o'clock GMT. New Zealand Central Bank official cash rate, no change expected. The Central Bank of New Zealand is expected to keep rates steady at 2.5%. Now we're going to take a look at the markets and see the latest movements of major currencies and the commodities, starting with euro as usual. We can see that recent recovery attempt of 5th of March low at 131.59 was short-lived and was basically cut by 55 days exponential moving average, triggering further weakness. Loss of 131.59 as main support in the near term. Dipped so far to 131.02. This was our next target, 131 zone, with current with current consolidation bounce higher seen corrective as the pair price holds around 131.50 zone, and also moving around 20 days exponential moving average holding below 55 days moving average at 131.73, and the more significant 132.40 zone keeps the downside in focus, as hourly studies are negative, still in the negative field, and the only break above 132.40 would improve the near-term structure. Larger time frames at 4 hours also a firmly negative tone. However, the RSI hovering around the barrier of oversold zone might signal some stronger bounce, but as mentioned, below 132.40 all the upside action is seen corrective. Also 20 days moving average at 4-hour chart at 132 zone offers quite strong resistance for now. Break lower to open next levels at minor support at 130.80 and more significant 130.26 beginning of February lows. Ahead of 130 round figure support, that would be our next target. Daily structure on the euro is losing traction. Studies are losing strength after the pair broke below the main bull trend line drawn of 129.73 low, 126.22 low, and currently approaching 55 days moving average at 130.73, which is the next dynamic support ahead of 130.25 and the 130.00 zone, and the key short-term support at 129.73 higher low of 16th of February. Daily structure is for now seen capped by 20 days moving average at 132.41, and basically only break here is to improve current outlook. Cable also remains under pressure after a bounce of 5th of March low when the pair briefly broke below 158.00 support with subsequent recovery attempt failing at 158.81, basically failing to regain the 200 days moving average, which is our main dynamic barrier at this point, and rejection just under this level at 158.81 triggered fresh weakness. The daily studies started pointing lower and losing traction, with the upside being capped by 59. Only break above 159 200 days moving average is to improve the current structure for possible test of 159.90, 160 zone. Our next upside target that remains out of reach for now. On the downside, the pair currently tested the 157 zone after losing also strong level at 157.70 November-December range ceiling that acted earlier as strong resistance, and now was support. Loss of this level 157.20 and 157.00 brought the price of cable down to 156.95. This was the low of yesterday, with immediate focus at 156.80 90 days moving average and 156.62 55 days moving average ahead of a key short-term support, and the higher platform at 156.50 also double bottom. A break of this level is to significantly weaken the structure of the cable, keep the upside firmly intact, and the possible reversal to the levels down of 155 155.20 would be seen the next as a 61.8 Fibonacci retracement of the broader ascent from 152.33 up to 159.91. Near-term structure is also weakening after a pair failed to sustain gains above 81.00 as the recovery attempt stalled at 81.57. Fresh weakness so far reached 80.56 where the consolidation attempt is underway. However, 20 days moving average, exponential moving average on the hourly chart so far caps the upside attempts, and basically a break here and 55 days moving average at 81.00, which is equivalent to the static resistance at 81, 81.14 is required to avert immediate downside risk. Otherwise, the likely scenario would be a test of 80.24 lows of 29th of February and extension towards our key short-term support at 80.00. This was a consolidation range of end of February floor, and basically break here is set to allow for stronger correction of the broader and strong uptrend from a 76.00 base. The daily studies are at their peaks, at their extremes, and they started pointing lower. That might be signaling a stronger corrective action ahead, as overextended values on most of the studies keep the pressure to the downside, and the possible loss of 80.00 as the key short-term support to open way towards post-intervention peaks at 79.50 and 79.00. Back to the lower time frames, studies are negative, as we can see that 4-hour studies are breaking below their midlines, and the price currently hovering around the 55 days exponential moving average, below which is definitely to focus 80.24 and 80.00 as our main target. On the upside, the regain of a previous high at 81.57 is required to ease the current bear pressure and refocus levels at previous highs at 81.68 and 81.86, and possible resumption of the broader uptrend towards 82, 82.20 next upside targets. The downside remains in focus for now, as near-term studies are firmly bearish and keeping the downside in focus. The dollar Swiss continues its strong recovery, a steady recovery of 89.30 double bottom posted on 24th and 29th of February, cleared some significant barriers. The last one was at 91 and the 91.60 previous high, as the pair extended gains so far to 91.95, just ahead of our next target at 92.00. Which is the around the figure resistance, and on the daily 92.31 is the 90 days moving average, and 92.54 55 days moving average, along with the previous range ceiling at 92.50 and the key barrier at 93.00. Daily studies, despite being under their midlines, started pointing higher and being supportive after pair broke above the short-term channel resistance line drawn of 95.73 high, and this keeps the upside in focus with the reclaim of moving averages of 90 and 55 days to refocus 93 and to confirm the bottom at 89.30 ahead of a possible fresh extension higher towards our highs at 95 zone and 95.73 high of 9th of January 2012. On the narrower time frames, the 4-hour study is still positive, but they are extremes. That might be signaling a near-term corrective action, while 1-hour studies are already pointing lower, as 91.65 now offers initial support ahead of a dynamic one at 91.50. 55 days moving average. At this point, only loss of 91 support zone would be harmful for the near-term structure, as this might delay the current strong rally in favor of deeper reversal. A quick look at commodities, starting with the crude oil. The price remains under pressure, as heading lower from 110.53 recent spike high posted on 1st of March. Since then, the pair is in descending mode. A loss of previous supports at 105.50 and 104.83 has so far seen 104.50 and keeps the downside vulnerable. Also, the break below the channel support now might open way for a further easing, with the levels at 102 and 101 seen ahead of a possible test of 100, our key support. Break of 20 days exponential moving average below 55 days keeps actually suggests a potential acceleration of the prices. As mentioned from fundamental side, the OPEC forecast for the lower demand in 2012 keeps the pressure on the oil price. The yellow metal, brief look at the 4-hour chart, we see that the yellow gold's price, after being capped at 17.25, opens a fresh leg to the downside following the first sharp decline of 17.90 that find initial support at 16.86. Further downside action has seen the loss of 16.86, extending losses so far to 16.63. On the daily chart, we see that the pair broke, the price of gold, broke briefly below 200 days moving average. That might signal further weakness, as we mentioned yesterday in our presentation and on other written analysis, that key support is basically at 200 days moving average, and the loss of which would significantly damage the current positive structure of 15.22 and open way for further extension. Immediate target is at 16.56, 50% retracement of 15.22 to 17.90 a cent, ahead of Fibonacci 61.8% at 16.25. This also risks the break below, basically loss of 1700 level has confirmed the top at 1790, and on the wider picture this is acting as a lower top, as the pair is still in the downtrend of 1920 record high of gold posted on 4th of September 2011, with the next high at 1802, and this one is now acting as the third one. On the larger pictures, strong support lies at 1522, 1532, double bottom of lows of 25th of September and 25th of December, and possible break here is to significantly harm the current gold structure and open way for a stronger and more significant reversal, as the yellow metal remains in the steady uptrend in the past, I would say 10 years, and and as we can see on the monthly chart, that there was no significant corrective action until now. So basically the critical level in the short to medium term is at 15.2232 double bottom, a loss of which might see some stronger reversal, and 161.8 extension at 1356 would be the next target on a possible break. Back to the lower time frames, current recovery is corrective on the 4-hour chart, as studies remain negative, but below their extreme levels, so we might see some corrective action. Immediate resistance, dynamic resistance 1695, 20 days moving average, and the next one as 1722, 55 days moving average, which is equivalent to the previous range ceiling at and previous high at 1725, and basically only break of this level is to ease the current bear pressure, as this level also marks approximately 50% reversal of the entire down move from 1790. Is basically exactly a 50% reversal, and only break here is to avert immediate downside risk for the gold price. I wish you a nice day.